Coming up in today's video, we've got precious metals moving lower. Meanwhile, I'm seeing a pretty good setup on oil that I want to talk about. The dollar index is showing some signs of strength here, and Bitcoin can't seem to get out of its own way, continuing to move lower, still under 70,000. With stocks chopping sideways and all sorts of uncertainties around the AI disruption stuff going on right now, where are these markets headed next? Well, in today's video, of course, I'll be talking about trade ideas and setups that I'm personally watching. As always, this is not financial advice. I'm simply sharing my thoughts and opinions on a wide range of markets. Let's jump in. Trump says he would back an Israeli strike on Iran's missile program if US-Iran talks fail. I thought that was a headline worth taking note of, considering I am long oil right now, and it's not necessarily because I think there is geopolitical unrest that is going to spill over into, Iran and all that situation, but there is a possibility of it, but that's not why I'm long oil. I wanted to talk a little bit about this idea that I have currently going on oil from both a technical and fundamental perspective. Let's start with the technicals, and for this I'm going to actually take a look at some moving averages to start things out. So we've been in a really persistent downward trend in oil for quite some time, but recently we were able to actually get above and stay above until now the 200-day moving average, which you can see here in pink. We were able to break decisively above that, but did come into some pressure once we hit resistance around $66 per barrel. While we got a little overextended in the short run, we have seen price pull back into this area of support looking left that so far has held really well for the bulls. Applying our moving averages back to the chart, you can see that we are starting to see some of these moving averages flip more into a bullish directional push. So I think that we have a breakout here in the opposite direction. We can also see that if we were to draw some trend lines here across this chart. You can see we have some downward structure that has seemingly broken that downward momentum and is now putting in these higher lows and higher highs on this chart. So from a technical perspective, I like the change in momentum to the upside. I think we have a strong probability of oil continuing to move higher and retest this prior high around 66. I like the momentum in this chart and do think that there is some upside potential. We also, again, have some very clear support areas looking just left here. And so if price does roll over, I have risk management on the trade. If we were to break the 61 level, that's going to be my cue to get out of my oil long. Let's now also take a look fundamentally. So a couple days ago, the Edge Finder was giving a stronger reading on oil, has now seemingly dropped that score a little bit down to a +1. So it's getting a neutral reading on Edge Finder right now, but let's at least highlight some of the things that are strong for oil in the time being, and some things that could potentially flip more bullish in the future. So first and foremost, we had really strong NFP numbers last week. Unemployment rate also moved down to 4.3%. So these statistics are very strong for the jobs market. However, we still have headwinds in the form of jobless claims, ADP, employment change, and JOLTS job openings all showing weakness. So on an overall basis, Edge Finder is slightly deeming the jobs market bias slightly more bearish towards oil. Of course, if you have Edge Finder, you can select any symbol from here and it will give you the scorecard respectively. Another positive thing or bullish reading for oil that took place last week was the flip on CPI. We saw CPI see 2.4% compared to 2.5% expected. This was a positive inflationary development. Why? Lower inflation means interest rates could come down. Interest rates coming down is an economic stimulus, which could then increase the demand for energy and oil. So we also see the 2-year yield getting a bullish reading here. Let's take a look on the technicals as to why that might be. And here it is. You can see that the 2-year yield actually started to move lower, and we have some momentum forming to the downside. This is perceived as bullish for oil on Edge Finder because lower interest rates are kind of being confirmed with this recent economic data that we got. Lower interest rates, as I pointed out, bullish for oil. So then, Nick, why aren't we getting a stronger reading on Edge Finder? Well, Edge Finder looks at fundamentals, but it also looks at sentiment and COT data, and it looks at technicals. I think the technicals actually could flip bullish if we get a day or two of strength. It uses a combination of moving averages and price action to determine whether the trend on the 4-hour and daily chart is up or down, and currently it is getting a bearish reading. However, a day or two of upside move, it's very close right now and could flip bullish again, which in turn could change the technical score to a much more positive one. Sentiment and COT data also are flat because what we can see here is that while institutions are overall pretty long oil, they have a 61 to 61 to 39% long to short ratio. Institutions are overall pretty bullish oil. However, in the recent week, we did see some selling on US oil. So this is giving us a mixed view on COT data. So institutions have a mixed overall, giving us that +0 score. So there are some factors here that could flip very quickly into a more bullish reading, but I'll continue to watch it. For the time being, I went long when this was giving me a strong reading, and I'll just honor the initial idea with my stop loss where it currently sits. By the way, if you don't have the Edge Finder, it is currently on super sale right now. I'll leave a link at the very top of the description to where you can speak directly to our support team about our current sale that we're doing. It is 40% off for a limited time to get access to the Edge Finder, and that is following last week's free week where we gave people a chance to try it out and see if it's right for you. If you are interested in taking advantage of these low prices, make sure to use that first link in the description down below. You can also request a payment plan if that is something that would be more workable for your current budget. And for those of you guys who want to explore the Edge Finder and all the different features, head over to our website. Simply go to a1trading.com, and then under Edge Finder, you can click tutorials. And through this page, you can pretty much explore all the different features and videos that we've done on the software. So with the 2-year yield shooting lower, this is definitely something that I think kind of confirms the data that we got last week. The bond market seems to be pretty happy with cooling inflation. And so we did actually see a little bit of a bid for bonds last week. Here's the TLT, which is 20-year treasury yield. 20-year treasuries. It's a bond ETF, and it actually shot higher, showing a little bit of demand for US treasuries. Meanwhile, while the stock market is closed for President's Day here in the United States, futures are still open, and we can see that the stock market continues to see a little bit of downward pressure. Last week was kind of rough for stocks, and actually the last few months have been pretty frustrating for stock investors, stock traders alike, or a lot of them at least, because we've really gone nowhere for multiple months. And a lot of people don't love choppy, ranging markets. And so what we've seen is a lot of kind of false starts and swings, and there's demand for stocks, but also people are worried about stocks, so there's kind of creating this channel effect that we see very apparently on the NASDAQ. And it just goes to show the state of the market right now. Last week, we pretty much had Goldilocks. We had cool inflation and strong jobs, and yet it wasn't enough to get this thing to make any sort of move higher. Just goes to show that the AI narrative right now is really strong. And if you don't know what I'm talking about, let me clarify a little bit more about the AI stuff. So for months and months and months, all you ever heard about was AI and how it's going to boost corporate earnings, and it's going to be amazing, and it's going to be a boom. And now we've seen everything kind of turn on a dime, where now AI disruption is the theme that people are worried about. So many businesses are now worried and under scrutiny by the market that AI could disrupt their dominance, their monopoly, their AI, or their kind of moat to their businesses. You can see headlines like "Why the AI scare might not be done." And all the disruption fears are just everywhere. And if you think that I'm curious what you guys think about this. Drop a comment down below. Do you think that this AI disruption is overblown, or do you think it is a very legitimate fear? I think that I'm kind of somewhere in the middle. I don't think it's fully fair to say that it's just overdone and overblown and there's no worries here. But I also think that there's a lot of good companies that are getting sold really hard right now because of these AI disruption fears. Basically, the disruption fear is that AI is getting so good, so efficient, that it's doing a lot of tasks, or potentially capable of starting to do more and more tasks that businesses of today's world have had a whole business built around. Think, for example, one of the ones that I see floating around is legal firms, right? Entire firms that do all sorts of legal work for big companies and stuff. If AI is more and more capable of doing the work of legal professionals, that eats away at some of the business models of the past. So it really does start to, and that's just one example. This thing is like a huge rotating wheel of like almost every industry is now getting challenged by, hey, could you get disrupted by AI, and could your business be obsolete in a few years? And if so, those stocks are getting really sold hard. And I'll go out on a whim here and say that I definitely think that some companies are getting hit too hard, but I would not be surprised if this is more than just a few, weeks of worry. I wouldn't be surprised if this is a theme that kind of plays on for a little while. And now we've seen both sides of the same coin, where AI can create tons of efficiency and optimism in the stock market, but at the same time, it can really challenge a lot of existing businesses, and that could cause some short-term pain for long-term gain in terms of corporate earnings. And also, it could cause short-term and long-term pain for employment statistics. If all this stuff is disrupting of jobs in the short run, maybe it does take away, the need for companies to hire as many people. And long-term, who knows? Could it create new industries? Sure, but could it also continue to eat away at available jobs? It's a dystopian and kind of creepy thought to think about, but I do think that there are things that humans will always be able to do, especially, personalities like me. I mean, maybe someday somebody will replace me with a complete AI. It's very possible, but in all seriousness, a lot of humanitarian type of jobs I think are safe, at least for now, because people want to see and communicate and work with people. Like, for example, a doctor, right? I don't know that I ever want to go to the doctor and just be a complete robot. I think I like the idea of speaking with a human who may be using and leveraging AI tools, but maybe that disrupts the medical world. Maybe you need less people on that side. It's a really fascinating topic, and I'm really curious what you guys think about it. Drop some comments down below, and I'll read yours and give you a heart if you drop something in related to the whole AI disruption stuff. Do you think it's overblown, or do you think that it is a valid concern and that maybe it's time to de-risk a little bit in terms of our portfolios? Today's video is sponsored by Ola Prime, which is a prop firm that I recently found out about and have been very impressed by. Their team is incredibly professional, and they have some of the greatest offers on the market that I have come across. Check this out. So Ola Prime offers fast payouts within 1 hour of request. They also offer up to a 95% profit split, and they have the largest number of trading platforms allowed that I've seen across the prop firm industry. They offer things like MetaTrader, which traders absolutely love, as well as several other trading platforms. And for those of you guys who are looking for a more flexible prop firm for swing trading and news trading, they do allow both news trading, weekend holding, and several other things that I'm not seeing all the other prop firms offer. They offer both direct and challenge accounts available now. They also have a 24/7 human customer support available for any questions or needs you may have. They have trading plans that are available for forex traders, futures traders, and even crypto traders. And in my personal opinion, this is the best prop firm if you are looking for something to tailor something specifically to your style of trading. Whether you're a swing trader, whether you trade futures, whether you trade forex, whether you're looking for a direct funding option or willing to go the 1 or 2 phase challenge parts, they have all sorts of different things that might fit your criteria and what best suits you as a trader. They're also recognized by Forbes for excellence, which is just a cherry on top. And for my subscribers, they are currently offering 35% off with the promo code NICK35 applied at checkout. Again, that's code NICK35 for 35% off. I'll leave all the information down below in the description for you to check out for yourself to see if it's the right fit. Thank you to Ola Prime for sponsoring today's video. Now back to the content. Let's take a quick look at gold also here. Speaking of some commodities that are looking interesting, from a price action perspective, we have resistance forming here around the 5,100 level. I'm watching for a strong break above here. While jobs data was strong, that inflationary cooling number and interest rates going down alongside it, I think could be a tailwind for gold. We do also continue to see central banks doing a lot of precious metals buying. However, there is a serious headwind for gold right now. Let me show you. Check out this headline, and this has spooked the precious metals. Whoops, let me try that again. So check out this headline, which in the precious metals world, check out this headline. Russia may return to the my goodness, man, come on. Get out of here. There we go. And check out this headline. Russia may return to the US dollar settlement system in Trump deal. What the proposed US-Russia economic partnerships includes, and is BRICS de-dollarization now a dead game? Basically, the idea here is that Russia may be looking to close the door on this whole Ukraine thing at some point. And if that does take place and they return back to kind of a trade, relationship with the West, Europe and the US, etc., that in some ways could be a strengthening factor to the dollar. This alongside a Fed chair that people perceive as potentially a little bit more, like he's going to protect the state of the Federal Reserve's independence, etc. That combination, I think, could lead to some dollar strength. Those are just sort of on the horizon ideas, but I do think that could have a little bit of a headwind on gold price. However, depending on how some of the economic data releases, still could see some upside potential. We also still see, as I mentioned, central bank buying going strong. So I'm going to let price action kind of guide here. If we can break through these highs and retest into this area, perhaps we do have further upside, and maybe we could even see a retest of those prior all-time highs at some point this year here on gold. Speaking of AI making people more efficient, let's use it right now to make my videos more efficiently. Check this out. Kevin Warsh actually has something to say on this, who is, by the way, the top contender nominated by the Trump administration to lead the Federal Reserve in 2026. He's positioned that artificial intelligence has a structurally disinflationary force that could fundamentally alter monetary policy. His thesis centers on the idea that rapid AI adoption will dramatically boost productivity, enabling the US economy to grow faster while simultaneously reducing inflationary pressures. Very interesting take on this, and I think it's actually kind of a valid one. If AI makes businesses efficient, it may also mean the less need for hiring, which is deflationary in a weird way. If less people are needing to be hired, the bid on workforce labor rates could come down. And that's not, again, that's kind of a creepy thought. It's not good for necessarily the average person, but for businesses, of course, they're going to love that, right? They need less people. They can work more efficiently on less headcount. It is in some ways deflation theory. And I think that this is actually a very interesting time for us as market participants, because I think we're going to see a shift in the way the Federal Reserve works. Jerome Powell, who I've mentioned many times, I think has done a pretty good job, all things considered. The Fed seems to be taking a new positioning, which is being more proactive rather than reactive. That seems to be, at least for now, the theory around someone like Kevin Warsh. Now, there's pros and cons about this. I know it sounds obvious. You're like, oh, proactive, that sounds better. That's much better. Well, sometimes Fed officials can get in trouble for trying to make big predictions and being wrong, and they often are. In fact, here's an example of where our current Jerome Powell has been wrong. He was very worried about inflation due to tariffs, and many would argue that he waited longer to cut interest rates because he was worried about tariff inflation, and it never materialized. So that's an example of being proactive and how it can actually get you in trouble, whereas being reactive waits for data to materialize and then you make decisions based on that. It's a double-edged sword. You always can poke fun at the way a Fed official does that, right? You can say if they wait too long, then they're going to be too late. But if they try and make big predictions, they can make things worse. So I think we may see a shift in the Federal Reserve being more proactive than the Powell administration or Powell team, right, has been. And so I think that could create some really interesting things, because this is a call that could be wrong. While I do agree with it, I recognize I could be wrong. Warsh could be wrong. This idea that artificial intelligence could be disinflationary could be wrong. So interesting times ahead, I think, with the whole change in leadership at the Fed. What do you guys think on this? Definitely curious on your thoughts. I thought this was interesting. Good deflation. Supporters of this view suggest that falling prices resulting from increased efficiency rather than from a decrease in consumer demand is a positive, right? Lower prices are good if it doesn't come with the bad side effects of tons of jobs loss and a really hurt consumer. Let's also take a look at some criticism, because with everything in economics, there's always pros and cons and people who agree. While Warsh has championed this view, many economists and market observers are skeptical, suggesting that it may be too soon to conclude that AI will provide a long-lasting transformative boost to productivity. And let's think about this. If this is wrong, we could get ourselves into some big trouble. What I mean by that is we could have a huge inflationary spike if this theory starts to become the way that the Fed positions and does things and is a wrong theory. It could lead to huge surges in inflation if AI does not cause some sort of deflationary force. So it's fair to kind of see the pros and cons of this theory or idea. So I do actually think that while Kevin Warsh is not the ultra dove that maybe people thought the Trump administration would select, I still think he is a dove, and he's probably going to push for rate cuts based on this theory around the AI deflation stuff. And I'm very curious what you guys think. Do you think that that is the right call to cut interest rates and to think that AI is going to lead to deflation, or is that too much prediction? I think personally that the concept of AI being deflationary is actually a pretty valid one, but my concerns are actually in the labor market. How are we going to keep people still, employed, the consumer holding up okay? Because if all this AI spend is causing businesses to be so efficient, at some point, if you lose jobs for everybody, then who's going to be the consumer that's making these businesses profitable in the first place? If nobody has, money except for the top 1% who are controlling the AI entities, it starts to get really dystopian and interesting. And I know I went down a whole theoretical rabbit hole today with this. Markets are closed in the US for the stock market, so I had a little bit more time to explore. I do want to leave off on an optimistic note. I think that new industries, like historically speaking, when new technologies come along, will be created through this new technology of AI. I just don't know exactly what those things are, and I can't tell you. I'm not, a fortune teller, but historically speaking, that's what we can look at. We can look at history and say a lot of times when the internet came along, or when electricity came along, or when farming, agricultural stuff, we went from a lot of human labor, and this is a weird area, but not necessarily just slavery, but like in general, like big, our agricultural shifts caused a lot of people's jobs in agriculture to be displaced by machines. And so people were worried about, oh, that's going to take all of our jobs. But people are interesting. People are resilient. Humans are capable of finding new industries and new things for us to be productive. And just as a side note, there's also this whole theory around universal basic income becoming a thing. And I'll go out on a limb and say I'm not a big fan of that. Not necessarily just because I don't know how we would afford it, but also because I think people want to feel like they contribute to society. They want to feel like they have input. I don't think people, I know in theory it sounds nice to sit around, collect a paycheck and play video games, but in actuality, I think people for a functioning society want to feel like they give input. I'm realizing we've moved really far from trading ideas today, but I hope you guys liked these theoretical discussions. I mean, I think about this stuff all the time because I'm just fascinated by markets, but let me know what you guys think on all that.
Hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.